Hello, good morning. My name is Roberto Carcache. I will be presenting a way to mitigate flood risk using catastrophe bonds. This is a joint work with Abraham Hernandez. Our field is pensions and asset management, but this was more of a passion project to get involved with studying climate risk and financial derivatives. Now, to give you a bit of background about this specific case study, it's a very famous storm in the US. It was called Hurricane Katrina. It hit a state in the southeast coast called Louisiana, where there's a city called New Orleans. It's quite small. And it was a Category 3 at the time of impact, but because of systematic failures in the city's mitigation, there were levees that were breached. This resulted in 80% of the city being flooded. So it was a very catastrophic event. Unfortunately, more than 1,800 people lost their lives. And there was 275 homes that were either damaged or destroyed. Now, in terms of insurance, also, you can imagine it was a very costly event. Private insurance companies paid over $41 billion in claims. And there is a public program called ICA2023 that basically tries to cover flood risk for vulnerable communities. They also paid something like $16.3 billion when adjusted for inflation. So as you can see, it's a very catastrophic event. We choose this because it is a very famous case study, and hopefully it won't repeat itself. Now, what we want to do with this paper is to develop a pricing model for this specific cat bond for a very small locality. So imagine if Sydney one day would want to do something like this. This is the idea of the paper. Cat bonds allow both reinsurers and governments to hedge catastrophe risk to financial markets. And for investors, the other side of the equation is an attractive product in the sense that it's not strongly correlated with other assets in the markets. Now, we use a public database from the MFI program because most of the catastrophe bond structures have third-party data, so it's not so transparent. So our idea was to use what is publicly available to develop our pricing model. To give you some context on this database, it's very large. It's 2.5 million claims for 50 years of history. And we have two key variables for our aggregate loss. It's building losses and contents losses. Of course, the data is much more richer, but in the end, we are studying the losses. As you can see on the figure to the right, it's a very heavy-tailed loss variable because you have a very extreme events. We have to censor this graph. We cannot show all the way because it would not look so nice. But we also adjusted for inflation. And then in our preliminary analysis, we took a look at the exposure as well through a number of policies. Now, in terms of geography, about the ICA2023 program, as you can imagine, due to flood risk, most of the communities are based in coastal areas. And the blue areas in the large map are those counties that have significant losses over a number of policies. As you can see, you have a lot in California, and then you also have in the eastern seaboard of the US. And this red zoom-in type of image is New Orleans Parish, because there you have extremely high losses stemming from Hurricane Katrina. Now, why do we use a cat bond? Well, in this sense, basically a very small area accounts for 13% of all claims for 50 years, just from one weather event. So in this sense, a cat bond is useful because it's one way to capture extreme event that is of very low probability. So as I mentioned, for the Hurricane Katrina, just for this city, the losses were $7 billion when adjusted for inflation. So it really is a very unfortunate event. And the cat bond is a way to hedge for investors, but for local authorities, it's one way to provide immediate coverage and relief for what is hopefully a once-in-a-lifetime event. And you can see this is the quarterly losses in the billions for this city, and there's just one event, which is Hurricane Katrina. Okay, now it's a bit confusing. I hope not so much, but to go into how these bonds are structured, there's basically two counterparties. You have on the left side, you have the sponsor, and on the right, you have the investors. So the sponsor can be a government, can be an insurance company, a reinsurance company. They are the ones that want to cover for extreme weather event or whatever it is. Now, these sponsors pay premiums that are deposited into what is called the SPRV. It's a collateral account. And the goal of this account is to invest these premiums into money markets, low-risk instruments, and to basically finance the coupons that the investor receives on the other side of the transaction. So what is different about a cat bond with a normal bond is that everything is contingent on what is known as the trigger. There are different types of triggers, but what you just need to know is if there is an extreme flood in this event, that is the trigger of the cat bond. Now, if there is a very extreme event, the investors may lose all or part of their principal. And if this happens, this money goes to the sponsor. It can be the government or insurance companies. Now, how would this bond look? And I'm trying to keep it not so heavy with the notation, but to go into traditional bond notation. Basically, we want a bond that can cover for another Katrina-like event. And our trigger is denoted M, and this is basically the losses of such an event. So this is a indemnity cat bond because it's based around losses, not about occurrence. So our face amount is 100, like in the traditional financial mathematics textbooks. And we're paying quarterly coupons for, usually in cat bonds, you have a floating rate plus a spread. So the spread is fixed. We discount with RT, and this is, like I said, usually money markets. And then the repayment of principal basically depends on the maximum flood loss recorded while the bond is active for the duration of the bond. So if there is a qualifying event, extreme flood, basically, the investors can receive part or none of their principal. How does this look in timeline? Well, we really want to find P. So you want to discount the bond, the cash flows for this bond. But the crucial component is the C, so the principal. And normally in cat bonds, you have tranches of risk. So in the first tranche that you see, 100 plus C12, that is a good scenario for, well, I would say for everybody, because you don't have an extreme event. So as an investor, you get everything, all of your money back, and you also get the final coupon. So in this sense, we defined it based on some existing literature. So basically 0.5 M is, if you will, like a half of a Katrina type event. If you don't have anything below that, if you have something below that, you get everything. Then you go into the different tranches, right? So you can get a partial payment depending on the magnitude of the maximum flood. And finally, at the bottom, this is known as exhaustion point, because here you have a catastrophe, basically. So if this happens, if you have some event that is a magnitude of M or greater, then you don't get anything as an investor. You just get the final coupon. It's a very simplified version of cat bond payment structures, but because it's our first approach to this, we wanted to keep it as, hopefully, as simple as possible. Okay, now to a bit of theory and assumptions. To basically, when you're structuring this product, you do not know what's going to happen in the future, if there will be a huge storm with such catastrophic floods. So basically, you can only simulate what's going to happen. And there are two main components to the simulation. One, you need the rate dynamics, because this is a bond. And we used a Check model, standard model, using 3-month US Treasuries. Now, the other component is the flood losses. And here we were a bit simplistic, and we used a peaks over threshold model from extreme value theory to basically find a good distribution for our losses. And we tested different ones, and this is in the paper, but in the end, this exponentiated variable was a good choice. And as you can see, again, we are just really worried about this maximum here. Okay, now these are done in simulation, so I didn't want to put a big chunk of code of how this is done. So instead, it's a table, but it's just to give you an idea of what the program behind this bond pricing is doing. Basically, you have the quarters, and each quarter, you're simulating a flood, a flood loss. And if we go back to the way that we put our definitions of the tranches, if this first column is less than 0.5, if any point, investors get everything back. This is the case for this specific simulation, because as you can see, at the end in C12, for C at T12, you have 100. So there was no catastrophe, everything is good. And then you have, of course, stochastic coupons, because they're variable. So it's not so complicated once you see it as a traditional bond. All you have to do then is just discount the summation of the discounted cash flows. And in this case, you have a bond that's worth 117. So it's being sold at a premium. Now, this is more data science type thing, but basically, you have to do this many times to get the expected value of the bond price. And for our baseline simulation, we set a trigger for 7 billion. So if there's one time, if there's a 7 billion loss, that's the catastrophe, that's the exhaustion point, which is Hurricane Katrina. Now, the risk premium for the discounting, we fixed it from the literature, 5%, just to be simple. And then the spread, we chose 8%. Cat bonds, because they are regarded as exotic derivatives, offer quite attractive spreads. And then the fair price for this cat bond after 10,000 iterations is 118. So again, the bond is being sold at a premium. So this is due to basically two things. One are the rate dynamics, and the other is the low probability of a full catastrophe or exhaustion point. Now, I like this plot because it looks like an eruption, but the points all the way at the top, above the one line in the y-axis, that is the full catastrophe. And the probability of this happening, the probability of exhaustion, is 1.93%. Now, you could argue this is actually high because if you look at the history of the whole city, it had never happened before. So maybe we are being very cautious with it. But everything below the 0.5 is the other scenario, which is when the investors get all of their principal back. And if we recall from bonds, obviously, if you have a lower interest rate, which is the left side, you have higher prices. You have higher prices and vice versa. Now, we did some basic sensitivity testing to find out what could be how good was our pricing model. And I think the most interesting is the finding of the spread, which is this graph. Originally, our baseline was 8%. So this is showing how the price of the bond changes as the spread changes. And you can see when you have lower spreads, the bond is lower price. And this is interesting in the sense that it just shows this is a bond. So it's what we can expect. Whereas in the other graph, we are playing around with the triggers to see if we have a lower or high trigger, how this could impact the price of the bond. And the effect is not so large. We would really have to go into very low triggers to see more of a change in the shape of this curve. We also tested the distributions of the losses. And again, it was quite similar to this. There was not a significant change. So this shows that interest rate dynamics and spreads and so on are a bit more important, at least for our base type of model that we have. And now to conclude, first of all, of course, you can have a more complex loss model. So we have been approached about this, and the idea of using, for example, a compound Poisson, because you can have multiple catastrophes during a given time period. So this can be a next step to take into account. Second is different payoff structures. So we use the tranches, but you can have a binary type of cat bond where you have a catastrophe or you don't, and that's it. You don't have levels. The third one is, it would be interesting to compare these results for neighboring counties or other vulnerable regions. So we chose a city of New Orleans, but we could, for example, do a cat bond like this easily for New York or Los Angeles. And it would be interesting to see the difference in the pricing. And the last point is not all countries, of course, have such thorough data that is public for flood losses. So at some point, it would be interesting to attempt this study with weather or hydrological data. Now, when we made this presentation, we hadn't done this, but we tried. And just to give an anecdote, there are water stations because in this city, there's a lot of rivers and lakes. So there's water stations that measure the level of water. And for the Hurricane Katrina, we looked at the data, and it was missing because most likely it was such extreme weather that the sensors were destroyed. So it's tricky to go into weather or hydrological data. But we will try maybe with different countries and see if it's possible. And I think that's it. Thank you for your time.
Thank you. We have a question already. As climate change continues, extreme events will become more common and more devastating. Can the model be modified to account for future increasing frequency and severity?
Yes. I mean, we saw when we were processing the data that there was, at least a national level, there was an increase in both frequency and severity. However, of course, as discussed by the other panelists, with climate risk, it's very difficult to know how severe it will be. We know that it's going to get worse, but there's always a level of uncertainty. So it's not so easy to model this uncertainty.
Mm-hmm. Can we get more questions, either in the room or online?
Luke. Hi. Did you compare your pricing to actual pricing in the reinsurance and cat bond market available publicly from Artemis or somewhere like that? No,
that's a good point, yeah. Actually, FEMA, which is they released the data that we're using, they actually have already issued cat bonds, so in the past 2 or 3 years. So yeah, we didn't have time to do it, but for sure I think it would be interesting to see. Obviously that's the point of this, not just to know how to model, but if you're an investor and you want to see if you're getting your money's worth, okay. So yeah, thank you.
Thanks, Will. Yeah, Will's also a bit of a guru on this topic. More questions? We have plenty of time, guys. Come on. Thoughts? Anything to add? Any experiences? You have one there.
Thank you very much. I am Abraham, the co-author of the paper. I mean, just that putting this also in context with everything else we see in insurance about solvency and liquidity risks, etc. I mean, this is a way for these kind of events, which are very difficult to cope with within the insurance industry, to have investors, be there pension funds, private investors, or hedge funds, taking that part of the risk. So this probably could be also, we have discussed about cyber insurance and how companies are afraid of taking those kind of unknowns as an industry. But as an investor, where you are not only investing in these kind of risks, you are mostly invested on financial risk, taking a big part of catastrophe risk makes sense at a fair price, of course. So that's the idea of these models, to make it easy quite easy for an investor to assess the opportunity of investing on this.
And just to add on what Abraham said, these bonds the market has grown significantly because of the increasing cost of reinsurance. So more and more it's becoming more common to see the risk to the markets, financial markets. So yeah, it's a very new thing. It's fairly recent, but it's increasingly growing.
The next one's quite technical. What is S is equal to 8% on page 12? Can you please explain?
Page 12. Yeah, I think so. Yeah, that's just the spread. Yeah.
Right.
Yeah.
Yeah.
So this is why we tested it here, the S, because it was an arbitrary decision. I mean, we're not actually making this bond, so we just choose a intermediate value. But yeah, in general, what's curious about, it's not just in the cat bond market, you have other types of risks that you might think are a bit strange. So for example, meteorites, sometimes covered with cat bonds. So those have really high spreads because it's like a very crazy type of product. So yeah, that's why we tested for different levels of S.
Yeah. Next is a really good question. How deep is the market? Are there liquidity issues for investors?
So the market, I don't have the exact figures of how big it is, but as I said, it's a very growing market, fast-growing market. But the liquidity is actually dealt with for this collateral account, because what this is not even, for example, if you have an issuer in the US, usually the collateral account is located far away from where the issuer is, to ensure that if there is a catastrophe, the funds are protected there. So that's the whole point of this account, to prevent exactly this counterparty risk or liquidity also.
I actually have a question. One comment you made that caught my attention was that a very small area is responsible for most of the losses. That was fascinating. Perhaps elaborate on that, on the implications of that. I mean, is the rest of the market subsidizing that? Is the pure market price being charged? Why bother insuring it? Shouldn't it be a government problem? I was just fascinated.
Well, I would say that, I mean, there's a lot of good documentaries about what exactly happened. Because yes, the local authorities had a big hand in it, because there was a lot of neglect in the maintenance of the levees, for example. But then, due to the human side of it, the tragedy, it was more important to rebuild than to cast the blame and who's going to pay for this. So yeah, it was a very devastating event, I would say, on a human scale especially.
How often does it reoccur?
It has not.
It has not.
Well, at least I mean, there have been recent very big hurricanes, but this scale, the previous one was in the 90s. It was Hurricane Andrew in Texas. It was previously the worst weather event in the US. This is now by far worse. And thankfully, there was a Hurricane Sandy that hit New York, but it wasn't as bad as this. I mean, this was the worst of the worst, I would say.
We have another technical question. Why did you use the 3-month treasury bills?
Again, well, actually, no, this was not arbitrary. We had a lot of help from our peer reviewer, who is an ILS analyst in Switzerland, in Zurich, and he recommended that in the practice, this is the product that they use. So they are invested in 3-month treasuries.
We have a question in the room.
Yep. This is kind of relatively new for me as well, cap bonds, but just wanted to question around when it comes down to the financial or trading activity behind the bond itself, given the structure of the principal, how it declines in value if an event does occur, what would be the sort of estimated recovery time of a price of a cap bond in markets, immediately after a cat event? Would it, like, for example, I'm looking to this like residential mortgage-backed securities. Once property market gains confidence again, then your asset-backed securities grow along with it. But how long do you think it would take for the price of cat bonds to recover post a cat event?
That's a good question. Honestly, I don't have a straight answer, because we didn't study the actual market, cat bond market. But I think because it's a very specific, specialized market, I don't think it's so influenced by the occurrence of catastrophes. I mean, because you have to think that, for example, this is just one area, but the market is, there's risk seeded from all over the world. So just because it happens in one location, the rest of the cat bonds are not directly impacted, because it's not like mortgage-backed securities where, the globalization of finance allows what you're saying. So in this, unless it's worldwide, like a pandemic, in this sense, I would say, yeah, for pandemic cat bonds, maybe prices have been affected in the way that you're saying, I think. But it's just an idea. I didn't study this.
Thank you.
Okay, I think we have another question in the room.
Thank you. I have a question on the timing of payments. So if the bond, is meant to pay the principal back in year 10, and there's a New Zealand earthquake that happens the day beforehand, and they have really large tails, how does it work with paying back investors? How long does that collateral account actually get to keep the capital before paying investors back? And
That's a great question. So the short answer is it depends on the type of cat bond. This is an indemnity cat bond, so it takes long because you have underwriting, you have to go actually check the losses. This is why more and more it's common to use occurrence cat bonds. So it's just as you say, in the case of earthquake, it's immediate because you measure the earthquake and then you can give the money directly fast to the people. There's much more literature available, cat bonds for earthquakes for this reason. And more and more was, as our peer reviewer told us, it's becoming more common to do occurrence-based because you want fast relief. You don't want a couple of years of paperwork and checking claims, you know, so yeah.
Okay, well, thank you. I think we have about 10 minutes left for general questions and answers. I think all the speakers